So I went to Gerald Loeb, who wrote this book about investment survival. He was this huge broker, and he was a famous man. Probably the biggest selling investment book of all times. You know what? He fired me in 3 weeks. Because I went in there and I said, I don't understand. We bought this stock at 20. It's 20 and an eighth and you sold it. He said, you don't understand the business. We made a commission. You must see life in the investment arena through the panorama of history. If you do not see life through the panorama of history, which we are going to cover quickly, if I'm not moving quickly enough, just tell me to move more quickly, okay? You know, if you do not see life through the panorama of history, and I'm going to make you very aware of it shortly, in precise terms, if you do not see it in those terms, you have no chance whatsoever of succeeding at investing except by random luck. And there will always be a certain number of people who think they're smart, who will have random luck. Market's going up, I think it's going up for the next 40 years. Bingo, you're right, and you think you're a genius. Does anyone here know if the market compounds for the next 20 years, where it will be if it compounds at 10% in 20 years? It's 10,000 now. 57,000. Now you pick up a newspaper. And there's an ad by somebody selling a book. If he's not a doom and gloomer, then he's somebody who sees the future, and he says 57,000. And you look at that and you say, 57,000? Oh my gosh, how could it be 57,000? I'm worried about what's going to happen to me tomorrow. Tomorrow, the world's coming to an end tomorrow. But it's 57,000, and it was 500, and it was 50. And America is a great place. And you can either be a believer or you can be Sewell Avery. Now we'll get to it more precisely in a minute. Do you want to be Sewell Avery? Or do you want the 57,000? Well, at our age, there are offsets to that. Because once you become wealthy, you only have to become wealthy once. Once you become wealthy once, you never want to lose it. Right, Ralph? You never want to lose it. It's not smart to go back to the Bronx, okay? But if you want to think in the real specific terms of what it's all about, as sure as we're sitting here, the market will be 57,000. Because if it's not 57,000, things will not be the way we've known them in any sense. So use history as the beginning, if not your end, to forecast what's going to happen. Those people, like Warren Buffett, to use the most premier example, and other people I know, build businesses and build investment portfolios with mistakes continuously, but they think really in terms of generations. Not in terms of this week, next month, next quarter. Who has the hottest idea on the stock market? May I share with you a quick story that's an aside? I mean, because if I'm boring you, I'll just go quickly through what we have. But let me share a story with you. Howard, should I share it? Sure. Listen, in 1962, I was running the Oppenheimer Fund. I was working with Leon Levy and Jack Nash. And some guy came in, and this is an absolutely true story. And Lou Brovman was in charge of the funds at that point. And this guy came in, and this is really important. He says, I got this system for forecasting the market. And he said, look, market's going to 220, and it's going to 92, and it's going to 79. And you want to know something? It went to 92, 22, and 79. This went on for 3 years. So I went down to Lou, and I said, we have to buy this. How can we not buy this? He looked at me, and he said, well, go back to the guy and ask him to explain to you how he came to his decisions. Sure. I was a kid. I went back, I said, Charlie. He gave me this cockamamie explanation. I went back to Lou. I said, Lou, I really don't understand what he said, but look, he got it right. He says, well, something you don't understand doesn't make any sense. So if you go to a money manager, I'll just throw this in parenthetically, forgetting about generations and short term, and he shows you their portfolio and their record and their history, and they can't explain to you how they manage their money, what their process is, how they do it, their record has no meaning. It's just dumb luck. When you put together a package of portfolio managers for you money, in whatever manner you choose to do that, you have to think you understand what they are doing, not just how they're performing. The best examples of that in recent history are the Janus Fund, or the technology funds, or the internet funds. In 1970, the Dow was 750. Now it's 10,000. That's 13 times. With all of the Sturm und Drang, noise, and everything else, you know how much the NASDAQ is up during that period of time? Anybody know? Jason, you know these things.
36%.
No, 15. 15. It was up 36 at the peak, but now it's up 15. So if you look at the Dow, how is it, and this is important to remember right now, how is it that 30 stocks can track the S&P with something known as an R-square of almost 95? Whether you bought the Dow, whether you bought the S&P, and you shouldn't buy the NASDAQ in that sense, but whether you bought the Dow or you bought the S&P, 500 stocks versus 30, you ended up the same way. You know why? Going to tell you why. Because if you took a dart and you threw it at a newspaper 1,000 times and you created 1,000 portfolios of 10 stocks, you know what the likelihood of those portfolios being precisely the same in their performance is? 95%. That is known as R-square. Any number of stocks selected at random, over 12 or 15 stocks, and it's even less, will end up in the exactly same place, okay? Now, this is important. For 5 years since 1940, how many losing periods have there been? In other words, what I mean by that is 1940 to 1945, 1941 to 1946, 1942 to 1947, 1950 to 1955, etc. Every single 5-year period. No matter when you started your investments, if you held your stocks for 5 years, what were your chances of losing money in the stock market in America?
50%.
None.
Zero.
0. 20 years? 0. 10 years? None. Now, my God, you're going to let that pass. Because unless you know that, unless you can assimilate that in your mind, how could you believe such a thing? Ralph, even you, who's a genius in investing, which you are, how could you believe such a thing? You would think, listening to all of Wall Street and all of the media and all of the newspapers and everything else, the market's always coming to an end. But if you held for 5 years, in every single period, it was impossible to lose. Now, that means that the few losing periods, okay, which everyone is influenced by, are very few. In 1973, 1974, there was the oil crisis and the inflation crisis. And if you had $10 million, it went down to $6 million or $5 million. But if you held on, how long did it take you to recoup your money? How long?
3 years.
Yeah, 3 years is pushing it, but 2.5 years. So here was this great decline, 2.5 years. This has been a very, very difficult period in the stock market for the last 4 years. It's 10,000 now, it was 10,000 4 years ago, but it's 10,000. It's not 3,000. And it had this huge run-up from 3,000 to 10,000. But it's still 10,000. So at our age, you didn't start your investment program 18 months ago. All of us should be really well ahead. It's been a flat period, but that's okay. So large company stocks, 5 years starting in 1950, there were no negative returns. 10 years, none. 20 years, none. Think about that. None. Now, however, there have been, how many down years since 1947? Anybody? This is a big, smart group. Come on, anybody, Sally? Come on, anybody. Lee, anybody? 13. So that's a lot of years. That's 50, 55 years. There's 13 down years. Other than 73, 74, and 2001 to 2002, there were only 2 years in which it took more than 1 year to recoup your loss. Now, that does not sound like